Welcome. Today I'm teaching you guys how to trade. By no means at all am I an expert. I'm just learning myself, but I want to teach you guys what I've learned so far about trading. It's options trading. I've spent time learning stocks and like the basics of stocks, but I decided to take options trading for a go. And I'm actually maybe even switching to futures, but this is what I've learned about options so far. First of all, your habits outside of trading really reflect how you trade. So it is 4:40 a.m. right now. I've been up since 4. I did my praying, my devotional. I drank some water. I weighed myself. I read the Bible, and I did a meditation. Now I'm on the treadmill just getting a walk in, and then I'm gonna have a shower, and sit down at the charts, and I'll show you guys what I do to mark out my pre-market levels and study the market before trading starts. So an options contract. One contract is 100 shares of a stock. So one contract equals 100 shares of a stock, and you have the strike price, which is, well, what is call option? Well, what an option is the right to buy a stock at a certain price, at a fraction of the price of this actual stock is worth. But you're betting that the stock, well, you're expecting that the stock will go up or down. So if you're expecting the stock will go up, it's a call option. If you're expecting the stock will go down, you buy a put option. As day traders, we want to buy the closest expiration. There's expiration dates on them. So when you buy the option contract, you get to pick an expiration date. So the expiration dates are always on a Friday. So like tomorrow's Friday, so tomorrow will be an expiration date, or next Friday, or the Friday after. For like 3 months in advance, you can do this. But as day traders, we never hold it to the expiration date. And as the expiration date ends, you get the option to exercise your contract or not. And if you exercise the contract, it means you have to buy 100 shares of the stock at the strike price. But if you just let the expiration date, like if you don't exercise the contract at the expiration date, then you just lose the price of the premium that you paid for the contract. The premium is the price you paid for the contract. But as day traders, we just choose the closest expiration date because we don't plan on holding the stocks more than a couple minutes to like an hour or like a couple hours at most. We're betting the stock will go in a certain direction, and we just take, as the price goes in that direction, we sell it back and take the profit. So, but the contracts are at a fraction of the price as you would pay for the stocks. So the contract might be 2.0, and we always choose the asking price to buy the contracts and the bid price to sell the contracts. So if the ask price is 2.0, you times that by 100 because each contract is $100, or there's 100 shares. So it would be $200 for the contract. There's slightly in the money and slightly out of the, there's in the money contracts and out of the money contracts. And in the money contracts have a higher probability of hitting that price. Out of the money contracts have a smaller probability of hitting that price. But what I do is do slightly out of the money contracts. So there's in the money contracts and out of the money contracts, and right at the edge of the in the money contracts, but in the out of the money contracts part, I take that call option or put option. Slightly out of the money is what you want to choose. And yeah, so that's pretty much the basics of it. I'll show you guys it in practice, in theory, and how I set up for the market open. I'll show you guys that too. In a paper trade today to show you guys with a larger amount of capital how powerful options can be. There is high leverage on them, but what you want to do is pick volatile stocks that are usually higher in price. You don't want to choose a small option price, like say the price is 0.1 is the ask price, but the bid price is 0. That's too high of a spread in between. The spread is too high. That's a lot riskier of an investment. So yeah, let's do some trades. To start the market day off, I always look at the news on forexfactory.com, check if there's any news coming up for the day, and I mark off my pre-market high levels, my pre-market low levels, my yesterday's high of day levels, and my yesterday's low of day levels. And it's called the close and retest method that we're going to be doing. Yeah, let's get into today's video. Forgot to mention the strike price is the contractually locked in price you're agreeing to pay for the stock. So the strike price is what could be in the money, at the money, or out of the money. And at the money strike price is the current price the stock is going for. And in the money strike price is what's probably going to reach. That's a high probability. But the out of the money strike price is a lower probability. But what I choose to do is go slightly out of the money for my call options and put options. First thing we do when we sit down is look at the market conditions. As you can see, most of these stocks are in the red rating on the bottom number. So that means it's a bearish market, and also S&P and QQQ are red. That means it's bearish. But we're gonna mark out our levels of the top percent losers because it's bearish. So what are the top percent losers? We've got 1.9, 1.2. We're just gonna mark out a lot of stocks, but right here we got 5.14. So we're gonna mark out what we do is we mark out the pre-market high, the pre-market low, which is probably going to change here pretty soon, but we'll just keep an eye on, keep moving it. Yesterday's high of day, yesterday's high of day, yesterday's high of day, and yesterday's low of day. Those are what do we want to mark out on our charts. Usually when I'm trading, I use TradingView, but I don't have real-time data right now, so I use Webull. Webull's what I'm using currently. A candle is one of these lines. So like one of these marks is a candle, and it tells you 4 pieces of information. This wick at the top is how high the candle got. The wick down below is the low that the candle got. And one of them is on the candles that are bullish, the top is close, where it closed, and the bottom is where it opened. And for the white candles here, the top is where it opened and the bottom is where it closed. I like to eat breakfast before I trade too. This breakfast is not enough protein that I need, but that's okay. So we're just watching the market, seeing what it does. Just to let you guys know, for the strategy to work, you have to be on a 5-minute time frame, and you have to wait for a close above the pre-market level or below the pre-market level. So for calls, you wait for a close above the pre-market level. For puts, you wait for a close below the pre-market level, which the pre-market level would have been right here. So you would wait for a close beneath there. But because we're still under the high of day, and on this part we're still above the low of day from yesterday, you don't take the trade. But we did do a retest right here after the close, the 5-minute close, and then a retest, and then it went all the way up. So that could have taken that trade, but it wouldn't have been A+ setup because we're below the high of day from yesterday. I hope you guys understand that. If you guys are wondering who I'm learning options from, it's called PB Investing on YouTube and all those socials. PB Investing is who I'm learning options from, and I use his strategy, the CNR method, close and retest method. What I also do before the market opens is check the daily chart. We trade on the 5-minute chart, we exit in the 3-minute chart, and we check the daily chart to see if the stocks are below or above this blue line. If it's above this blue line, it's good for calls. If it's below this blue line, it's good for puts. So another term you might want to learn is longs and shorts. If it's longs, it's the same thing as calls. It's when you're expecting the market to move up. If it's short, you're expecting the market to move down. My guy that I watch for YouTube just went live on Discord doing his live trading for Thursday, so I'm just going to follow his trades that he takes today and try to win some money or make some money. Just want to share with you guys, trading is boring. Like, you're sitting here looking at charts non-stop, just waiting for something to give, and it's already almost 8 o'clock or 7 o'clock, so I've been sitting here for half an hour just looking at charts and haven't taken a trade and just been looking, and that could be for another hour and a half. I could be doing this, so it is pretty boring, but if you become profitable at it, it's well worth it. Today might be an example of when you just don't take a trade. If it's not an A+ setup, you just don't take a trade. If it's not looking good, if you don't think you're gonna profit money, profitable trading is boring. It's supposed to be boring. If it's exciting, you're probably gambling. More efficient way of watching the stocks if you split your screen. The market is chopped today. I've been sitting here for over an hour and haven't taken any trades. Looks like there's nothing to trade today, guys. It's almost 8 o'clock. I've been sitting here for an hour and a half just watching charts, and there's nothing to trade. Day trading is boring, but if you can just wait for those A+ setups, you can pretty much make a month's worth of salary in like a week, so, or like more than that. So okay guys, I officially didn't take any trades today, so I'm just gonna go to the gym. I'm closing down. Guys, I don't usually do this, but I'm back on the charts for PM session. So afternoon session starts at 9:30. It is 9:30 right now. And just checking. But you also what I didn't mention earlier is you have the pre-market levels, like the lows and highs, and then the high of day and low of day from yesterday that you mark out. But there's also psychological levels like $2, $1, $3. It's like all psychological levels. 350, 450, like the main like numbers are all psychological levels. Even like 340, 330, like they're all psychological levels that they could bounce off of. By the way guys, I went to the gym and did an upper body, but my arms are absolutely cooked. Like my shoulders and my arms right here are cooked. They hurt so bad. So tomorrow is definitely leg day. I did 4 upper body days in a row, and my arms and my shoulders are cooked. Why you always like to trade in the first 90 minutes in particular is because that's when the market is most volatile. And we're trading the momentum, and we want the volatile market. Because you guys understand what I was trying to say with this whole method? There are criteria that have to meet. Like, you have to mark out your levels. And if it gets here, I'll go back to IWN. You have to mark out your levels. But if it gets under the pre-market level and under yesterday's low of day, then you wait for a retest of the VWAP, because this line is underneath. Or you wait for a retest of the pre-market low, but the pre-market low was under the pre-market yesterday's high of low of day. So you wait for the retest of the VWAP, which would be right here, because it's under the pre-market level and under the high of low of day yesterday. So the retest would be right here of the VWAP, where you see how it comes back and taps that line? That wick right there that comes back and taps that line, and then it goes all the way down here, and that's where you catch the trade all the way down here. Came back, retested right here, went all the way down here. Hope you guys are understanding what I'm trying to say. Hey guys, I entered into a trade right here. If it goes back this way, then I'm going to stop out and lose the money. Well, it's a paper trade, but if it goes back this way, I lose. If it goes down like this, I profit. I did it because there's a retest right here. See the retest? And we're below pre-market levels and the low of day level. You can see I took this trade. It's going the wrong way now, so I'm probably going to stop out here. That trade didn't work out. We got stopped out. Might have been down, but I entered back into the trade because we had another 5-minute retest right after that. Right here, it retested again. Now we're going trending with the momentum in the right way, so I just entered again. So there's my stop loss is back down here to where that candle closed, and now our take profit is down here for wait, I'm gonna turn the take profit down a little bit to 1 to 2 risk reward. Looking like I made the right choice entering back into this trade. As you can see, the candle's going down, that white candle. But when it's officially time to get out is when it closes below this blue line. So if it closes below this blue line, we're officially getting out. So we're gonna actually move our stop loss down here. So now it's a 1 to 5 risk reward. Actually, we're gonna move it to break even. So we're gonna break even. And so now we're not risking anything. Our stop loss is right here, so we'll break even here. So if it goes back towards here, we break even. If anything above here, anything below here is profit. Been in this trade for about 15 minutes. We've almost hit the take profit right here. I'm just gonna wait. I could close it at any time and just take the profit off the table, but I'm just gonna wait until it hits our take profit line. So just get maximum amount of money. Hit our take profit. I'm still keeping it in. I'm keeping it in. I'm keeping it in. This is where you trim and then you leave your runners. So you sell out like the majority of your stocks, then you leave some to keep going higher or lower, I mean. I'm still in. We're down here now. 1 to 22 risk reward ratio. I'm still in. I'm going down lower. Okay, I'm taking it. Canceled the order. We just made $34 on that trade. $34 on that trade. $34 on the trade. $34 on the trade. We could have left, if we had more than one share, we could have just taken that one out and then left the runners to keep going to see how low it goes. Technically, we could have stayed in and been getting all this profit right here because you don't actually have to get out until it closes below this blue line. As you guys can see, it kept going. It didn't go below this blue EMA, so we could have stayed in and we would have, let's see what we would have made. How many risk reward would have been? Would have been 11, a 1 to 11 risk reward ratio. Could have got all that money. Would have been probably at least double what we just took off. But I'll show you guys. First trade we lost $23, and then the second trade we made 39 or whatever it was. So came out to $14 for the P&L. Forgot to add, we get out of the trade in the 3-minute time frame. So if you're exiting the trade, you do it in the 3-minute time frame right there. And we also look at the 1-day time frame, because if it is above this blue line, you trade calls, but if it's below this blue line, it would only be ideal to trade puts. It was still a day of profit. I just did one share just to show you guys the basics, but if you do more I just did one contract to show you guys the basics, but if you do more contracts, it's obviously going to be double the money for each contract you get. So yeah, and usually you get like multiple contracts, so I just did one contract to show you guys how to do it though, so I hope you guys did learn something. But that is how you trade options, guys. That is how you trade options. Hope you guys learned something from that trade right there, and everything that I taught you today. I just wanted to also say I apologize that was like full talking voice and that wasn't soft spoken. That wasn't really ASMR style, but I should have done better at making it soft spoken. I'm sorry about that, guys. Hope you guys did enjoy that video anyways, and if you guys want to see another trading day of soft spoken or maybe even whispering, let me know and I could do another trading day showing with more contracts and higher stakes and stuff like that. And yeah, hope you guys have an amazing day, amazing rest of your day or night. Subscribe to the channel if you're new here. Hit that like button if you did like this kind of content and you want to see something similar to it when I learn futures, because I'm learning futures from a mentor starting tomorrow. So I'm going to be trading futures after this, guys, or I might stick with options, but I'm going to learn futures tomorrow from a mentor, and then I'm paying to learn from him. So see you guys.